Well, I hope we are live. Good morning, everybody, or good evening, rather, to everyone out there in the world. All right. We have a very exciting stream today. We're going to be covering REITs and real estate investing. All right. This is typically a topic that's more reserved for, YouTube videos and things like that. I don't really do lives on this. I cover mostly stock market stuff because it's just there's so much abundance of news, right? There's so much abundance of news in the stock market. It's so easy to cover that kind of stuff. Real estate is just very boring, right? Real estate's very boring. There's not a whole lot to it. Once you learn it, you kind of buy it and you just let it sit and let it do its thing, right? There's nothing sexy in real estate. Real estate is a very boring asset class. But today we're going to be covering kind of a couple different ways you can invest in real estate. But not only that, I'm going to be covering not just REITs, but I'm also going to be covering something called private placement offerings or real estate syndications. These are reserved for really wealthy individuals. We're talking people with net worths of over $1 million or that they make basically 200K a year, right? These are very sophisticated investors. Right. So we're going to be covering, mostly that stuff and the benefits to investing in real estate syndications. And then I'll be also talking about just, kind of REITs in general and the different types of REITs out there. Now, I'm not going to cover every single REIT because if I was, this stream could easily span for a couple of hours. So what I'm going to do instead is just talk about, REITs kind of at a high level. And then I'll get into the real estate, the private placement offerings, later, and then kind of just go through that stuff, a little more in depth, just so you guys can understand the differences. All right, so this is going to be a jam-packed stream. Hope you guys really enjoy this. Like I said, I put a lot of elbow grease into this one, and this is going to be a lot of word salad stuff. If you guys don't understand the terms, don't freak out. Put it down in the chat, and I'll go over it, and I'll explain what it is. REITs, real estate, rental properties, my favorite stuff. My favorite asset class. I don't really talk about it too much. All right. So, hey, just checking the chat. Welcome back, Senpai. Welcome back, Alex. Strategies over spreadsheets, profits over screenshots. All right. So, all right, guys, let's get into this. All right. So we're going to get into this. And again, before I get started, I have to put the disclaimer out there, not a financial advisor, and I'm not raising for any deal. I'm not trying to veer you in one direction or the other. Every asset class, has its own merits. Every investing comes with its own risk. Do your own due diligence. Talk with, an investment advisor, etc. Blah, blah, blah. I'm just some dude on YouTube. All right, guys, let's get into this. So King of Big Mac. I don't think I've seen you on the stream. So, hey, welcome. Poll needs more options. One day I'll have real estate properties. Hell yeah. I think I think investing in real estate it has its benefits in a total portfolio. All right. It has its benefits in a total portfolio. If I wasn't living abroad, I would definitely be investing in real estate right now or investing in rental properties. But because I live obviously out of the country, my ways or methods of investing in real estate are sort of limited. I could still invest in rental properties. I did for a time, but then it just became way too much of a headache. Anyways, I'll get into all of that and more. All right, so let's get into this. So I'm going to front load all the portfolio stuff, all the stock market stuff at the beginning, and then we'll just get into the REITs real quick. So real fast, portfolio value sitting at $414,000. We had a really good green day today, and pretty much this week, right? Nothing makes sense anymore. It seems like it's all narrative driven. It's all news driven, right? It has nothing to do with earnings, has nothing to do with anything, right? Tesla missed their earnings by a whole lot, and still the stock popped. So, really big, nothing makes sense anymore is essentially it. So everything's driven by the top three dogs. You have Donald Trump, who does news conferences every day, and the market is hanging on his every word. The same goes for Scott Bessent. He just came out with a interview that I will be looking at after the conclusion of this stream because I think it's going to be very valuable. All right. King of Big Mac asked what do you do if you don't mind me asking? So currently I don't do anything. Like I just do YouTube and investing. I live out here in Thailand. I don't have a W-2. I left my job some time ago, I think last August, and I was just kind of tired, and I wanted to take a huge break. And you know, investing basically allowed me to have that option. So taking a break for now and just kind of, you know, trying my hand at entrepreneurship, trying my hand at YouTube, and seeing how it goes. Right. All right. So let's see. G bro, what's up? Citizen of the Year says, I'm here for the dividends, for the big dividends. Hell yeah. All right. Fast money is the best money. No, just kidding. All right. So anyways, instead of a $70,000 loss, I'm down to a $63,000 loss. You know, we had some great recoveries over the last day. So really great there, really happy there. And again, I'm just going to keep riding this wave of, you know, hopefully more green days in the future. If it, you know, I had to sell one of my positions in order to keep some cash on hand, just in case, you know, we were continuing to head for lows. I still think, yeah, we'll be a little more choppy until after this earnings season. So I just want to hold a little cash, and then I'll jump in where an opportunity presents itself. So that'll do it for this portfolio update. Let me pull up real quick. Where is it? All right, let me just pull this up real fast. So this is where the portfolio sits right now. Of course, I'm using a lot of margin. I'm sitting on about $25,000 worth of margin that I can deploy at any time. So I'm just kind of sitting on it for now. Buffer is looking pretty good, still low risk. I did purchase 29 new shares of MVW, which is the NVIDIA Roundhill weekly pay ETF. So I purchased an additional 29 shares today. So I'm just going to sit on this and let it go. This has been, NVIDIA has been getting hammered. So I just wanted to pick up some shares while they were still on the cheap. And then I'll just ride that up to recovery. So outside of that, nothing new here. All right, guys, we're going to get into the real estate segment, and then we'll go from there. So I got to show, let's see, got to log in here. Alex says, why only 10.3% and not 120%? That's what I'm saying, man. I just need to invest in, I need to filter my stock picks by highest yield and just invest in the highest yield, period. And forget the rest. Forget fundamentals. Forget what the company or the fund or the ETF or whatever it does. I don't care. If it pays 100% yield, I'm going to buy it. And I've seen stocks that pay more than 100% yield, you know, out there. Of course, I don't know if they're any good, but I'm just saying that they're out there. Come on, it timed out. You serious? All right, sorry guys. M1 Finance times out every time I try logging into it, and I have to re-log into it every single time. Man, I screwed up that password. Sorry guys, I apologize. I should have been way more prepared on this, so I apologize. All right, it's logging in now. Okay, all right, cool. All right, cool. So a lot of you guys who've been following me or following this channel know that I have a really sizable portfolio of REITs, right? So I invest a good portion of my money in real estate investment trusts. And it wasn't until recently that I'm, you know, basically cash out of a 401k, move my money to tech, and then, you know, started also investing into high yield dividend income ETFs. But REITs is really where I was investing a good majority of my money, and real estate and rental properties, things like that. So this is the REIT portfolio. All right. This is what we're going to be covering today. There's a lot of sectors in real estate. So when you hear things like, oh, the real estate market is crashing, it's like, well, what part? Because there's a lot of them, right? Just like in the stock market. When you hear people say the stock market is crashing, I mean, most people will look at the S&P 500 and just be like, yeah, I mean, it's down 5% for the day. Yes, it's crashing, right? For real estate, you know, you hear these headlines all the time, and mostly what they're talking about is pretty much apartments, right? Pretty much apartments. They're talking about commercial apartments. They're talking about that real estate crash. You know, they're talking about housing, right? They're talking about single family housing. Now, single family housing and commercial real estate are two separate two separate sectors within real estate. Maybe not sectors, but two different niches, if you want to call it that. They're completely different, right? You have residential housing, which you and I, you know, we rent a house, we rent an apartment. That's what we live in, right? Then you have commercial real estate. You'll have things like cell towers, data centers, logistics, warehouses, huge apartment complexes. You'll have self-storage. You'll have triple net lease. You'll have manufactured housing. You have all these different other sectors in commercial real estate. So, you know, you just have to dig through the weeds whenever you hear these things. But you guys, of course, know that, and I'm ranting right now, but you guys know that I do own a lot of REITs, all right? So this is the REIT portfolio, and I'm always, well, I'm very bullish on REITs, right? I'm very, I just love the asset class. I can't explain how much I love the asset class, because I know that based on history, based on, you know, total returns, that REITs outperform the broader market over longer periods of time. So how do I know that? All right, so let's get into this. So this is an article from the Motley Fool, and I'll put a link down below in the description for you guys at the end of this stream, so you guys can check this out. But I've covered this in one of my videos, that REITs outperform the S&P 500, right? And it's primarily due to a couple different things. One of the bigger reasons why REITs outperform is because of the 90% that they have to pay out in the form of a dividend, right? So REITs, they're not really going to, like, their share price is not really going to like pop like tech stocks or you know, some other types of stocks in the stock market. You know, it's probably like biotech companies, but they're very slow growing, right? But what they do is they pay out a lot of cash. They pay a huge dividend. Maybe not so much like the cover call ETFs, you know, where they're paying you out like 100% distribution rates, but historically speaking, REITs have always paid out, you know, a higher than normal dividend rate. It's similar to like what a BDC is, a business development company. You know, business development companies, they'll pay out about 90% as well. So REITs are no different. And that the reason why they have to do that is because of law, right? When REITs came about, so REITs came about, you know, through the Cigar Act. They had this little page in the Cigar Act that basically said, hey, we want to create or establish REITs, right? Real estate investment trusts. And what this allowed was mom and pop, you know, regular retail investors to have access to institutional quality real estate, things like apartment complexes, things like office buildings, you know, to name a few, right? So that's basically how REITs came about. But in order to be a REIT, they have to make sure that they pay out 90% of their 90% of their rents, and they're not really tax efficient vehicles for investors, right? You're not really getting all the tax benefits. The REIT is getting all the tax benefits. You're just getting paid out, you know, a higher than normal dividend, and usually that dividend has a couple different classifications. You know, it's going to have you know, return of capital is going to be a qualified dividend, or it's going to be just classified as normal income. And those are really the classifications that are coming from the REIT, because when they either refinance a building or they sell a building, right, or they're just collecting rent, they're paying you out those profits in the form of a dividend. All right. So that is pretty much where it's coming from. But if we look at this, the FTSE NAREIT, which is the National Association of Real Estate Investment Trusts, they have an equity index, right? They have an index just like everybody else. And this index has outperformed the S&P 500 over many, many years, right? Over many years. So since 1972 to 2024, it's outperformed the S&P 500 by a whole 4.5%, right? May not seem like a lot, but, you know, the S&P 500 is touted as like the best thing you should invest in, you know, 10% returns when annualized over long periods of time, which is true, right? There is merit there. You would, you know, I believe that any investor should have an allocation to the S&P 500. It's just my own belief that that is like the most passive vehicle. You capture the entire market. You don't have to worry about stuff. So anyone should have an allocation to that. But if you look at other asset classes, things like real estate, they outperform, right? REITs outperformed the S&P 500 over greater periods of time. It's only when you start getting closer and closer, right? You have the past year where REITs are just getting pummeled and hammered out, and equities are absolutely outperforming, right? But if we look at like the 10-year, that gap starts to close, right? Over the past 10 years, the S&P 500 returned 11%, whereas REITs returned 7%. Okay, so not that bad. And then when you zoom out a little bit more, 20 years, you have the S&P returning 8.3%, but you have REITs returning 9%, right? Beating the S&P 500. And then zoom out to 25 years, the S&P 500 returned 6.2%, REITs returned 11.7%, right? And it just continues to go higher from there. So REITs, again, I'm a big believer in REITs. They outperform, not very sexy, not going to get you rich tomorrow, right? Like cover call ETFs or high dividend yielding ETFs and things like that. And of course, I say that as a joke. But these are total return vehicles. These take a lot of time, and over longer periods of time, they will outperform a good majority of companies. There was like, you can look at something like Mid-America Apartments, MAA, and stack that against, a lot of other companies in the index, and you'll find that MAA has outperformed even some of your favorite picks. All right, Realty Income, ticker O, the monthly dividend paying company, they've outperformed the S&P 500 many, many times. And then you look at Public Storage. Again, this is a self-storage. You see them all the time on the highways. They've beaten the S&P 500. Like their total return has almost trounced the S&P 500, right, over longer periods of time. So again, REITs are unloved. They're very, they're not really popular with a lot of investors. Dividend investors, very popular, but more so the younger crowd, the growth type of investors. They're chasing the tech stocks, they're chasing the tech sector ETFs, they're chasing the cover call ETFs, they're chasing, whatever is going to get them richer faster, right? But this is really like an old man's type of portfolio, right? This is what old people invest into, but not just old people, very smart institutions, also invest a good amount of money into REITs because of how stable they are, how much of a stable asset they are. Just because the share price on REITs go down doesn't mean the fundamentals change. REITs have balance sheets just like companies, right? And they have to maintain a couple metrics. One of them is occupancy. If they have high occupancy, meaning that, all their rentals are being rented, they're getting all that cash flow. That's one metric. If they're growing their assets, they call it, their NOI. If they're growing their NOI or same store NOI, if they're growing all this stuff, then the REIT's doing really well. They're, like, even though the share price might decline, it doesn't mean that it's a bad stock. And I think that's what a lot of investors, the first thing they do is they look at the chart, right? They look at the 1 year chart, the 6 month chart, the 5 week or 5 day chart, 3 month chart. And they're like, oh, this is a bad REIT. Look how bad the share price is. If you look under the hood and look at the balance sheet and look at how much this, REIT has compounded over time, you'll find in most cases for a lot of good REITs, a lot of large cap REITs, that these things are just powerhouses. They are just powerhouses. All right, so real quick, we're gonna go through a video because I don't want to explain, word for word what a REIT is, but anytime I want to know more about REITs, I go to NAREIT or REIT.com. All right, this is the source for all REIT related stuff. So if you're a fan of REITs, if you want to learn more about REITs, this is where you should take a look. All right, so we're gonna just take a quick look at this video.
REITs, or real estate investment trusts, were created to give everyday Americans the opportunity to own income-producing real estate, an opportunity that had been available only to wealthy investors and banks. REITs allow anyone to invest in real estate by buying their stock, either directly or through a mutual fund or ETF. In the same way shareholders benefit by owning stocks in corporations, the stockholders of a REIT earn a share of the income produced through real estate investment.
All right, so this is an indirect way of owning real estate without having to take out a loan, without having to go to the bank, without having to have a good credit score, without having to come with a large down payment, right? Something like 20, 25,000, probably a lot more nowadays. If you're going to go in with, a 20% conventional loan, then you need 20% of whatever the value of the property is. So you guys, taking a look around your area, whatever the cost of a house is, conventional loans are about 20%. There's other products out there like the FHA loan, where you could put 3.5% or even 4% down. But it comes with a pretty hefty PMI, a property mortgage insurance, which you would have to pay for. REITs, if you have $10, if you have $25, you can invest into real estate, right? Indirectly through a REIT, which is, I think, a very awesome way to invest and get exposure to real estate without having to deal with the 3 T's, tenants, toilets, and trash, right? Or even dealing with a property manager. Now, the return profiles are going to be completely different. The risk profiles are going to be completely different between REITs and, rental properties. But anyways, staying in the same vein of REITs, I'm just going to cover this real quick. Why should you invest in REITs? Competitive long-term performance, substantial stable dividends. Not every REIT's going to pay out a stable dividend. Sometimes, you get dividend cuts, especially for the poor, quality type of REITs. But for really, really good, well-managed real estate investment trust, you're going to get a stable dividend and a growing dividend at that. It's not going to be, choppy. It's not going to be one day they pay out this much, and then the next day they say, hey, we're going to have to cut it because our balance sheet is getting wrecked, and we're getting wrecked by debt maturing. All right. So that's another metric that most people have to look at, is how much debt a REIT has. Liquidity, again, you can buy and sell REITs moment's notice, right? On Robinhood, M1 Finance, Charles Schwab, Vanguard, whatever. When you buy into a REIT, you click buy, right? You buy a couple shares. And if you want to sell, you click sell and you're out. Whereas if you're investing in rental properties or investing in, private placement offerings, not so easy. There's high transaction costs and there's a lot of fees. All right. So, and not only that, but on average, it takes about 90 days to sell a property, right? On average, it takes about 90 days to sell a property. There's transparency when you invest in REITs. All right. You can read the shareholder presentations. You can check them out on the SEC. All this stuff, right? The SEC, if they're going to be listed as a REIT and traded on the public stock exchange, there's a level of transparency that they have to meet. So again, if you're one of those types of investors that likes to read in the weeds, that is one way you can do it in investing in real estate. Whereas if you're investing in private offerings, you get an email update maybe once a quarter, maybe once a month. They might go over the financials, but they don't even have to email you back. They if you ask a question, they can just, ignore you. I've heard that happen in private placement offerings. So you have to be careful, which I'll cover a little later. And REITs obviously give you portfolio diversification. All right. So there's always this talk, there's theme out there that portfolio diversification is a free lunch. It's easy to do. It doesn't cost you any money, and it's the best thing an investor can do. So REITs add to that diversification. If you're heavy into equities, maybe you might want to consider opening your portfolio up to REITs. Again, it's exposure to real estate. That's really the aim of investing in REITs, is you want to get that exposure, right? So if we look at, kind of where commercial real estate sits, it's the third largest asset class after bonds, stocks, and, there's cash in there as well. But commercial real estate is where a good majority of wealthy individuals place their money. All right, I mentioned it, and I couldn't find the chart, but I mentioned it in one of the streams. Tiger 21, wealth management firm for very, very wealthy, high net worth individuals. A heavy amount of money that these individuals invest in is private equity and real estate. Those are the two asset classes, or the two investments that a lot of these high net worth individuals are placing their money. They're not placing it in equities right now because, it's just, there's too much uncertainty going on in the world. All right. So anyways, let's take a look at a REIT. All right, so this is a REIT. Again, if you guys have questions, place them in the chat, and I'll get to those questions. I know I'm going through a lot, and some of this might be big brain in you. It might be a little big brained, but if you have questions, feel free to place it in the chat. All right. But okay. John Rambo says, I don't have any REITs, but I do use Fundrise. I'll be covering Fundrise here in a minute. But anyways, let's look at Avalon Bay Communities. This is traded on the stock exchange. This is ticker AVB, and this is a ticker I invest into, right? Avalon Bay Communities is probably one of my favorite apartment REITs. Of course, you have to do your due diligence. This is not a pitch to invest in Avalon Bay. All right, so this is just kind of the company at a high level. Annualized since 93, 11.9%. Right. That's pretty good. That's above 10%, right? That's above 10%, the whole S&P 500 thing, right? So that's above 10%. And it's, got a really good dividend. It's been constantly increasing its dividend since its inception. So Avalon Bay Communities is A+ in my book, right? Annualized dividend growth since 2000, 4.9%. It's got a really good credit rating. So this is an investment grade credit rating. It has 306 communities. This is the part I want to really push here. When you invest a single dollar into Avalon Bay Communities or any type of REIT, usually they have hundreds, if not thousands of apartment units or, other assets, right? So maybe warehouses, maybe self-storage, maybe you invest into triple net lease, so you'll have like thousands of store locations and things like that. But when you invest into these REITs, they usually come with immediate diversification, right? There's 306 different properties in Avalon Bay communities, okay, that span 93,000 different apartments. That's crazy, right? If you put $25 into this REIT, you're going to get diversification across 306 communities across the United States and 93,000 different apartment units. Whereas if you invest into a single family home, if that tenant decides, hey, I don't want to pay anymore, now I need to go through 3 months of eviction, you lost all your cash flow, and they're probably going to wreck the place, right? So having money in a REIT, you don't have to deal with any of that stuff. So that's always, kind of a good thing. That's always a benefit that I look at. So this is just a quick overview of Avalon Bay communities and, a publicly traded REIT and kind of the benefits. So looking at Avalon Bay communities investor presentation, we're just going to go down again. We just kind of covered this stuff, $93 billion or $39 billion in enterprise value. They're across 10 regions, California, Texas, Florida, North, South Carolina, and the Northeast, right? So they have a lot of properties all over the place. Let's see what else they got. Yeah, 306 communities, 93,000 apartments. All right. So this is just some of their accolades over the past 30 years. They're just killing it. Again, I like Avalon Bay communities. This is just more stuff that they're doing, right? I'm not going to go too in depth into this stuff because this can turn into pretty much a word salad and a number a number entree. So we're just going to skip all this stuff. But you can look at this, right? You can look at this and kind of decide if this is something for you. All right, so this is Avalon Bay Communities. This is a REIT. This is an apartment REIT that has several different properties all over the United States. So let's look at kind of just what this looks like, right? So these are some of the apartment that they have that are live right now, right? That you can actually go out and rent yourself. So when you're investing into Avalon Bay communities, these are some of the properties that you are investing in. This is where your money goes to, right? It goes to providing good quality living for renters, right? This is a fitness center right here. They got a nice apartment. Everything's looking great. Then you have these other, right? Like this, your money's going to something like this. Like this is really cool. It's not just look at a chart and then be like, oh, this thing is going up to the right. This is a good REIT, right? It pays out a nice little dividend. No, there's so much more that your money is going towards when you invest in these REITs, right? This is really good quality living, right? So if you're very bullish on apartments and you like apartment, buildings, and you like real estate and where it sits, then this could be something that you look at, right? This could be something that you put your money in. So this is just one way to look at REITs, to put kind of a human touch on it, because a lot of people, again, will just look at, they'll just go straight to the seeking alpha. They'll look at the chart, they'll look at the dividend, and they'll be like, this is a crappy investment. I want something that pays 10%, right? And then they'll filter by highest yield and invest in that. So that is not what we want. Especially when we're investing into REITs. All right. So moving on, this is Blackstone. So Blackstone is the 1,000-pound gorilla in the room, right? They are one of the biggest REITs out there, or one of the biggest asset managers out there, right? And they have a private REIT that most people cannot invest into, right? Usually you got to work through a broker, and the broker will say whether you can or can't invest in this, and they come with their own stipulations on who can invest in these things. But when you invest into, this is known as a public non-listed REIT, all right? A public non-listed REIT, or private non-listed REIT, I should say. This is not traded on the stock exchange. This is not traded. You can't buy this. You can't click buy and sell, right? When you invest your money in this, it comes with a lot of disclaimers. Your money's locked up. The manager, i.e. Blackstone or BREIT, they can deny your redemption request. They could say, hey, like during COVID, a lot of people were trying to get their money out of like Fundrise, right? Or get their money out of BREIT, or get their money out of these private non-listed REITs. And the managers were basically saying, nope, you cannot get your money out. We're not going to redeem your request. We're going to hold the money. We're going to hold all the money for the foreseeable future until we feel comfortable releasing money, right? And that could be a benefit or it could be a negative. The benefit to something like that is, investors are emotional. In the stock market, you guys see this every single day. As soon as, negative sentiment comes out, the man in the White House says something bad, or Elon Musk makes a tweet, then stock goes down, right? Nothing completely outside of your control. You cannot do anything about that, right? And you're going to take massive loss. Whereas with something like REIT, the net asset value is not going to go down because the manager basically stopped all the redemption requests. They said, nope, until we feel comfortable releasing the money, because they don't want the ship to sink for, because of a few people. So again, it could be a benefit or it could be a con, right? It depends on which part of the spectrum you're in. Like if you really need the money and say your mortgage is due, you got bills piling up, and you want to get the money out, well, yeah, you're not going to get the money out from something like REIT, right? But, if you're an investor on the opposite end of the spectrum, you're also not going to see your REIT investment go to zero or crash because, a bunch of other investors freaked out and they wanted to get their money out of the market, right? So again, this could be a benefit or it could be a con. It depends on who you are as the investor. So just real quick, looking at some of this, 9.4% annualized return since inception date. And I believe REIT came out at around 2017. They have several different share classes. Again, these each come with their own unique requirements or, different return profiles. Like if you look at the class S, different, right? If you look at class I, a little different. And then these also tell you, who's allowed to invest in these types of shares, right? So I think institutional class is one of these is institutional class. The other one is for like retail investor. But yeah, not too bad. Annualized distribution rate about 5%, as far as a dividend yield. And then this is how many transactions that they had, right? So Blackstone is buying up the place like it's going out of business, right? They're buying up as much real estate. They're sitting on a couple $1 billion, not a couple. They were sitting on like $70 billion worth of dry gunpowder, and they're waiting to deploy that money into real estate, right? And you as the investor, you're going to benefit from this because as they acquire new properties, the cash flow goes up, the NOI goes up, by all metrics, it goes up, right? But you have no control over this. Blackstone does everything for you. You don't have to pick and choose. You don't have to say, well, I like AVB, but I might not like, MAA or whatever, right? They do it all for you. So it's completely passive. You put your money into this and you just let it run. All right. So that could be attractive for some investors. I personally never invested into REIT. I did look at investing into it at one point, but I chose against it because, again, I wanted more liquidity and I wanted more control over my investments. So that's why I went with publicly traded REITs instead. But it doesn't mean that this is bad by any means. It just fits a different profile of investor. Maybe if you're like a little older, you're pretty much near or at retirement and you just want steady, predictable income, then something like REIT could be for you, right? Of course, you got to do your own due diligence, etc., right? So real quick, how does REIT stand up against something like the S&P 500? Well, since 2017, the S&P returned about 12.85%. Okay, when annualized. So REIT returned 9.4%. Right. So I know people are going to be like, oh, well, the S&P 500 just beat out real estate. Well, look at it in a different light. In order to actually make money on the S&P 500, you'd have to sell the shares, right? You'd have to sell the shares. Whereas something like REIT, they're going to be paying you out a distribution, right, of 4.8%. The S&P traditionally or historically usually pays under 2% for the dividend yield. So again, take that for what it is. If it fits your income strategy or, future, plans, you have to kind of take that into account as well. This is why I find dividend investing a lot more attractive than growth appreciation plays, because I want to be able to collect the cash flow. I don't want to be forced to sell shares in order to make up my own dividend. So, just my own thoughts on that. So again, this is what REIT is investing in. They're investing in data centers. All right. They're investing in industrial. they're investing in rental housing, right? You can see their portfolio makeup right here, which is really, really cool. Because I had this idea at one point, like, why not just copy the bigger players, right? Why not copy someone like REIT or Starwood, right? Copy their portfolio. And you absolutely can. You could copy multifamily. You could plug in an AVB, right? Single family homes. You could plug in something like Invitation Homes. Student housing, I don't know any student housing REITs. I don't know affordable housing REITs. Usually affordable housing and multifamily is usually mixed in. Industrial, maybe go with something like PLD, in my opinion, or Turno. Or Torino. Data centers, you have Equinix, you have, who else you have? You have Equinix, you have Digital Realty Trust, right? DLR, EQIX. You can go with those, right? You can copy almost Blackstone's investment strategy or thesis by plugging in a bunch of, REITs into this portfolio, right? And creating it on something like M1 Finance or something. So I thought that was really cool. I thought that, that was a cool idea. I don't know how it would play out, of course. And you definitely want to go with probably the larger caps, the more responsible companies. But I just thought it was really cool. But you can see that that the 1,000-pound gorilla in real estate is staying away from office, right? They have a small allocation. They're very bullish on multifamily and all types of housing, industrial, and data centers. That's what makes up a bulk of their investment, right? Self-storage, retail, office, the lowest of the low. Hospitality, very low. These are like hotels and things like that. So again, I just think it's really fascinating to look at this kind of stuff. And you can kind of surmise and put the data points together that, like, holy crap, like, maybe multifamily might be the best way ahead, right? So just my thoughts on everything. This is another one. I'm just going to briefly cover this. This is Starwood REIT. This is one of the bigger competitors to Blackstone. This is also probably the 900-pound gorilla in the room. Again, really, really big player in the space. I'm a big fan of Starwood. I don't have any investments in Starwood, but they have a mortgage REIT, and so does Blackstone. Blackstone also has a mortgage REIT. BXMT for this mortgage REIT, I think it pays like 10 or 12% dividend yield. Starwood REIT pays, I think, about same thing, actually, 10 or 12% dividend yield. So again, these are two big players in the space. I'm a big fan of Starwood. I know the CEO has a book. I never read it. I want to read it, but just not enough time in the day. But yes, they also have one. Again, this is same thing to BREIT. They have certain share classes. They invest in a portfolio similar to Blackstone. And again, you could just kind of look at what they have as well. Like occupancy, again, that's really a big deal. Total asset value, $22 billion in real estate. Number of properties, 601, right? They've been out since 2018. They even talk about how much leverage they have, so how much debt they have. So half their portfolios in debt. That's probably maturing. The problem with these is that they don't give you like the same problem with these is the same problems that you have in, say, something like Avalon Bay Communities. You don't know the actual property values, right? You don't know the individual property values or the problems that they have, right? They give you a very high level thing because they're managing everything. So they take care of everything. So you have to put a lot of trust in the management, right? So this is their geography, their balance sheet. So you can see that they have a lot of fixed rate, which is really good. Fixed rate means that, the 5.5% interest rate that they're paying on all their debt is going to remain 5.5. This right now, the floating rate financing, that'll change with the interest rate. That is what is killing a lot of real estate investors right now and a lot of REITs because they have a lot of this. The more responsible REITs will have fixed rate debt that matures, in a couple of years. But anyways, we could see again from their portfolio, they have apartments, again, affordable housing, and then, industrial. They have a little bit higher allocation to office, real estate loans, and then a couple other ones. It doesn't look like they have any data centers in here, right? But again, multifamily, very bullish, right? That's what a lot of these big players are investing in, and you can see some of their some of their properties that they invest into. Like this is what is hospitality, right? So this is looks like a hotel of some sort, and then they have housing, industrial looks like. So again, really really cool. Another way you guys can invest into REITs and get kind of diversification away from the stock market. So I'm going to just cover this real quick because I know we're running short on time here, but this is Fundrise. All right. This is what you can invest into passively as a retail investor with something like $500. You could put this money in and they will manage everything for you, right? This is a publicly traded, or excuse me, this is a public non-listed REIT, okay, versus the private non-listed REIT. This is a public non-listed REIT. This is what they, kind of give you as benefits. So Fundrise, I would prefer Fundrise over a couple other competitors. Fundrise didn't do a bad job with my money. They actually made me a decent amount of cash, but I wanted more control over my portfolio, so I sold out of Fundrise and moved all my money into REITs. All right, but I'm not sour about Fundrise. I think it is a great platform for probably non-sophisticated investors. Don't take that personally. It's just investors who want exposure to real estate. They don't want to do all the due diligence, and they just trust the manager, i.e. Fundrise, so they'll put their money there. They have actually done better than V&Q, something like a Vanguard, a real estate investment trust ETF. So again, just something to think about, something to look into. All right, so covered all that. Now I'm going to get into the actual real estate syndication stuff. All right. I know this has been going on long, so I apologize if this is a little long in the tooth. All right, so let's look at real estate syndications, okay? So I hope you guys can see that. All right, cool. All right, so let's take for a second that you want to invest in directly into an apartment complex like this. Like this is something that looks cool, right? Real estate syndications, this is reserved for really higher net worth individuals or sophisticated investors. There's usually two types of classes here. You have accredited investors and non-accredited. The accredited investors has like $1 million net worth, minus primary residences. And you have to prove this with an accreditation letter from like a CPA or something, right? Saying that you are indeed an accredited investor, you meet these thresholds. It's very easy to get. It costs like $50. But either that or you have to make $200,000, consecutively, 3 years, right? 3 years basically, right? But those are really the two conditions that most people go after. I was an accredited investor for a little while, for about two or 3 years, because I had a ton of rental income coming in, plus my job, and then, plus the dividend income, et cetera. Right. So, I met the accredited investor status and I was able to invest in, these types of private offerings. Okay. The second one is the sophisticated investor or the non-accredited, right? These are people who don't meet those thresholds, but they have a decent amount of money in their portfolio that they are smart and they understand the markets enough, right? So they have some reasonable level or expectation of understanding the investment. So that's really what a non-accredited investor is. Now these offerings, these private offerings, these come in two different flavors, 506B and 506C. And again, guys, I apologize if this is getting really into the weeds, but I just want to explain this. The 506C offerings can advertise. These are the things you'll see on Facebook, the things you'll see on like Realty Mogul, or the things on CrowdStreet, right? These are offerings that are available to the public as long as you meet the accreditation status, right? So you can invest in apartments like this. There's websites available. There's CrowdStreet.com, which is one of the popular ones. Doesn't mean it's the best one, right? They have a couple lawsuits against them. You also have syndication companies that offer this. If you guys are familiar with Bigger Pockets, that is one company that broadcasts these 506C offerings, right? There's also these syndication players or these teams of investors that will go after these types of buildings, right? So that's the 506C. That's the public offering. Now for 506B, these are private, like you cannot advertise, right? They're going to take on non-accredited investor. These are the golf course buddies, right? These are the people, the doctors that these offerings are not allowed to be advertised, right? And they can only, they have their own stipulations for 506B. The beauty of both of these is that they're highly regulated by the SEC. There is a lot of legal stuff that goes into both of these offerings. So there's some level of legal protection, at least for the investor from these, but it doesn't mean it's going to protect you from losing money. All right. Which I'll get into in just a moment. Okay. So this is essentially what the syndication kind of framework looks like. So Citizen of the Year asks, how do you invest in the Blackstone one? Usually you have to work through your broker to get that. There's also these, like when I was looking at investing into them, I was going through a private club in order to invest in them because they were going to get, a little less of a fee. But usually there's these clubs out there that have access to investing in them through like private links that you cannot, like, you can't give those out. You have to contact a broker of some sort in order to invest in Blackstone REIT. Those are the two ways that I know of. If you go to the website, there's no way to create an account and invest. At least I don't believe there is. So you have to work through a broker of some sort. So hope that answers that question. But so anyways, this is a syndication model. Typically you'll have two teams. You'll have the investors, right? You'll have the investors, people like you and I, accredited, non-accredited, and we'll have the GP team. The general partner team, these guys and gals, they're the ones that found the deal. They underwrote the deal, right? They said, hey, this is going to give you these kind of returns. This is the business plan. We want to buy a building. We want to add value to it. We want to fix up the curb appeal. We want to renovate the place, probably put water in the pool, and then, pay out money, in the form of rents as distributions to you as investors, and then sell the property in 3 to 5 years, right? That's usually the business plan for most things. And there's a bunch of benefits to this, right? There is a bunch of benefits. So usually the team will form an LLC of some sort, and then they'll go out and purchase the apartment complex. The limited partners typically come out with, a bulk of the money, somewhere in the realm of like 85 to 90% of the money to actually buy the apartment complex. And the GB team is responsible for the 10%, the remaining 10%, and managing the property. So you guys can see that there is a little bit of risk here, because if the GP team is absolute garbage and absolute trash, they can lose the entire deal and your money can essentially go to zero. So this is where you have to be really careful who you team up with and kind of what, the track record of the GP team. You'd be surprised. The real estate syndication space is extremely small. If you put a name out there on these real estate, groups, or these real estate syndication Facebook groups, or chat rooms and things like that, more times than not, there's probably someone that knows who they are and whether they're good or bad. You can also Google a lot of these people. I've Googled names and found that, they have a podcast, they have a YouTube channel, they have books that they've written, publicly facing, looks like a great person. But when you dig under the hood, you'll find that they have lawsuits, they lost deals, they scammed investors. So you got to be really, really careful with this stuff, right? Like syndication investing, it has high risk, high return, right? But it all involves you doing your absolute due diligence on the teams and on the project itself. There's a lot more work that goes into it. So this is, again, the syndication structure. So this is, again, I got to put this out there as a disclaimer. This is a mock presentation. I'm not raising for any money. All right. This is a mock presentation. This is all educational purposes only. So let's say you wanted to invest in this, right? You got an email from somebody and someone's like, hey, invest in our deal. We're going to give you all these fancy returns. We're going to have a webinar and blah, 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 right? You're like, oh, this sounds interesting. Let me take a look. So this is generally how it goes. Either you sign up for, alerts or newsletter or something, or maybe someone that's on the GP team, right? A real estate investor, and he approaches you or she approaches you and says, hey, I'm thinking about doing this deal. Let me know if you're interested, right? And it piques your interest, and you're like, let me take a look at the presentation, right? Usually with these real estate syndications, they come with something called a offering memorandum, right? The offering memorandum basically tells you what their business plan is, what they want to do, how much they need to raise, kind of the financial aspects of the property, the area that it's located in, is it a growing area? Is the population good? Is there a lot of work? Is it blue collar, white collar? All this stuff you need to check, right? You need to double check, because the offering memorandum, sometimes they're painted in a very peachy, rosy point of view, right? They look good. They have all these really nice numbers. You don't even know what they mean. So it's up to you as a real estate investor to look at this stuff and make sure it makes sense, right? Because population growth is a big deal. The town that they're investing in, say that, it's a 100-unit apartment complex, but there's 200 people that live in this town. Well, you have a little bit of risk there because if people leave and there's a bunch of homes and a bunch of inventory, well, you might not want to invest there, right? But it's up to you to do the due diligence on these people, on this team, on this project, right? You have to look at everything. You can't just trust, unless you really, really trust the person on the GP team. It's very ill-advised to just go in based on trust. You really have to do your own due diligence on these projects, all right? Because these projects can go to zero. They can absolutely go to zero. You can lose your full investment. All right. And we're not talking about $100, $25, $5,000, or even $10,000. We're talking $25, $50, $75, $100,000. Right. And there was nothing you could do. Once your money is locked in and tied in these projects, you are stuck. You are stuck in there through thick and thin. Right. There's all these legal documents you will sign, disclaimers, things like that, or PPMs, private placement memorandums, that you'll be signing. And it basically outlines all the fees that they get. It outlines all the risks associated with this. It outlines everything. So this is why you have to be very careful with how you invest in these. All right. So this is what a typical thing is, right? They'll ask for $100,000 investment, and this is what they promise or what they project will be your returns. Okay. So $31,000 in cash flow, and these are real numbers, all right, from a deal that I actually did invest into. All right, so the projected cash flow is $31,000. Your equity share, meaning that once they go to sell the property, this is what your projected, equity share will be once they sell that property. It'll be $77,000. So, and you get your original $100,000 back. So your total investment value or your total return will be about $208,000, right? With your $100,000 included in that number, right? So that's 108% return over 4 years. You're not going to get that type of return in most of the stock market, right? In most areas of the stock market, you're not going to get that. No S&P 500 index, equal weighted, covered call, whatever, is not going to give you that number. All right. So this is a total return vehicle, right? And this is really how a lot of investors will multiply their money quicker over shorter periods of time. Now, there's also a lot of tax benefits that go with this, right? You guys know that tax benefits are abundant in real estate. You get tax depreciation, you get, cost segregation, you get mortgage interest write-off, you get all these other things, plus the repairs and maintenance, that also can be written off on your taxes. But you don't deal with any of that. The GP team is the one that deals with that. And what they do is they give you a K1, right? This is a tax form that lists out everything. So you just get this one K1 and you hand it off to your CPA along with your taxes, right? Very easy to do. Whereas with REITs, you're going to get a 1099 div, right? 1099 dividend form. And it'll include all the dividend income you got, and you give that to your tax person. If you're owning a rental property, you gotta bookkeep everything. You got to bookkeep all that stuff, repairs, maintenance, receipts. You have to deal with, the mortgage company, get that document. If you have a property manager, you got to get that document. So it's just a bunch of documents you collect and then consolidate and then send off to your CPA. So there's a lot more documents when it comes to rental property investing versus syndication investing or real estate investment trust investing, right? But this is what makes real estate and syndications very attractive, is how fast you can actually multiply your money if the deal is good and if the deal actually pans out the way it's supposed to. There's deals where this number, this 108% return, was so conservative that their actual return was about 150 to 200%. All right. So $100,000 could easily turn into, $300,000 or something like that. Right. With cash flow and equity all tied in. So typically in most of these syndications, the GP team will do a, conservative estimate on, the real estate investment that you guys are doing. Right. They'll do conservative numbers. But again, not every GP team is good. There are GP teams that have screwed up great deals, and there's GP teams that turned horrible deals into great deals. So again, it really depends on the GP team and your due diligence on that area, on that asset class. All right. So I hope I covered a lot of that. This is what an actual thing would look like, right? An actual return, right? Let me just take a look at the chat real quick. Let's see. Citizen of the Year says, I'll just invest in BXSL. I mean, yeah, it's completely passive, pays a really good dividend. I'm a holder of BXSL myself. So I really like Blackstone. So that's the thing, referring to why can these people advertise, in public, even though they have lawsuits and things against them, is because they can. There's nothing illegal about it. You have to, as the investor, do your due diligence on these people. Just because they have lawsuits doesn't prevent them from doing any type of offerings. There's GPs who ended up in jail. There's GPs who took all the LP money and fled to another country, right? So you got to be, again, extra careful in your due diligence when you're vetting these teams and vetting these individuals. I've heard of horror stories and I've seen it myself where, a GP team, they will have internal fighting and bickering amongst themselves, right? So let's say there's 4 or 5 people, right? And it's a friend of a friend and of a friend who brought them into the general partner team. You as the investor, LP, you're like, hey, I'll give you guys 100K. You guys, do your deal, right? But the GP team will start bickering like, hey, you're supposed to do this. Hey, you're supposed to do that. Or, I don't like this person anymore. They don't respond to my emails. Or you email the GP, investor relations, and they don't even reply to you. I've seen all this in real time. I've seen this, not with any of the deals I'm invested into, but I've read about these horror stories, right? And I've seen these on these chat rooms and these forums. So again, there's nothing illegal about showing this. It's what happens after the fact, lawsuits, jail time, and things like that. So again, the SEC, it's a very regulated industry. So if investor fraud is apparent, investors have recourse. They can take legal action against most syndicators. All right. If they were actually doing, wrong, if they were actually wrongfully trying to screw over the investor. So again, there's a little bit of protection there, but again, you're putting up a lot of risk. You're putting up a lot of money. And if things go bad, you got to hire a lawyer. That's additional money, right? So again, you got to be real careful. So anyways, real quick, let me just cover this. I know we're close to our 1 hour. This is one of those times where ROC makes the most sense, is real estate. Okay. You want return of capital. Real quick, I'm sorry I forgot to answer Alex. Alex asked, isn't illiquidity bad? Yes and no. It really depends on you as the investor. Illiquidity means that your money's locked in. You can't just hit sell, right? That could be a good thing, right? Especially in real estate. You have stocks going up and down, losing 10%, 15, 20% in value, and then jumping up and down, right? Like we've been seeing. Real estate is an illiquid investment. If you buy a rental property for 100K, tomorrow it's probably going to be worth 100K. Next week, it's probably going to be worth 100K, right? Usually it takes some time and months for values to either go up or go down. And real estate is one of those asset classes where it doesn't really spike in price. More often than not, it doesn't really spike in price. It takes a lot of macro things to happen. Interest rates, economy, migrations of people, right? A lot of people left California and they moved to Texas. Texas values went through the roof because hundreds and thousands of people were moving to Texas, which drove rents up, and then the rents drove the properties up. Right. So again, it takes huge macro events for things like that to happen, or usually some type of government intervention. So unless those things happen, property values typically don't go up or down. So illiquidity could be a good thing, right? Investing in MLPs also required K1 forms. Yeah, exactly. So MLPs, master limited partnerships, they'll give you out that K1. Typically, those are like your energy pipelines and utilities. So those will give you the K1. I like K1s over, I forget the other tax documents, not the 1099 div, but I like K1s. They're a lot more simple, and they give you the depreciation, which could actually bring your tax burden down, right? So K1s, in my opinion, are a lot more favorable than 1099 divs. Of course, every investor is different. All right, so coming back to the sample profit breakdown for this apartment complex, right? Let's say you put in 100,000. This is where ROC makes the most sense. ROC, return of capital. This is a refinance event. So let's say you put in 100,000 and you give it a year. And in year 1 or year 2, they're going to say, hey, we're going to refinance the property, meaning that we're going to get new debt and we're going to give you back a portion of your money, a return of capital, right? We're going to refinance and give you your money back, and it's all tax-free, right? You don't have to pay any money off of this. Let's say they give you $70,000 or 70% of your money back, right? So they give you $77,000. You can use this money for anything else. You could put this money into another syndication. You could put this money into stocks. You could put this money into other real estate or whatever else. Maybe you go out and spend it at the casino. I don't know. But you can do whatever you want with this money, right? This is what is known in syndication space as the snowball, because now you could take this money and put it into another syndication. That syndication in year 2 will, pay out another refi and you'll get that money out, and then you invest into another syndication, right? So you're literally building your snowball from real estate syndications. Meanwhile, though, you're still in the deal. You're still a part of the limited partner team, even though you took out 70% of your money. So you still can collect cash flow. So that is, again, that's where it makes a lot of sense. That is where it's very attractive. So you can compound your money a lot quicker, right? Then of course you're going to get the cash flow, and then, eventually the sale of the property, which would be, like, let's say $31,000, plus your refinance proceeds. So, you're going to get also your cash on cash return, so you can get a total, excuse me, you can get a total return of about $166,000 on this $100,000 investment, right? So, may not seem like a lot, but when you factor in your tax benefits, when you factor in the cash flows, when you factor in how much risk you took on and, over how many years and et cetera, it could be a very attractive way of investing in real estate. Plus you had to do nothing aside from the due diligence at the very beginning. You didn't have to attend phone calls. You didn't have to answer your phone from tenants. Your tenants didn't smoke crack in your rental and stop paying you, right? The GP team is responsible for handling all of that, answering all those late night calls, dealing with the property manager, right? And they take a fee, of course. But you, as the limited investor, you had nothing to do with that. You just put up the capital, you sit back and collect mailbox money, unless the deal goes really bad. So that is what makes this really attractive, right? And again, it all depends on you as the investor, if it makes sense for you. These are just some real quick ratios. You have the average annual return, which is the AAR. This is the IRR, which is more or less a complex formula. I can't even really truly explain it. But 24%. Then you have the equity multiple, which is a ratio of how much money you can expect to get returned, right? So usually like an equity multiple of like 2 means that they're going to double your money. An equity multiple of 1.6 means that you're going to get your money plus 60%, right? So that's really how you want to look at these equity multiples. It's just a quick way of going through, investment presentations, right? That's really it. It's just a quicker way of going through whether the investment makes sense for you or not. And then you get the COC, or the average cash on cash return, 20%, right? This would be your dividend, right? This would be that dividend yield that you would get. So this, might make sense for you. All right. So that's going to do it for this presentation, guys. This is just a quick breakdown of pros and cons. I'm not going to go through the whole thing. You guys can take a screenshot if you'd like, or review this video after. But this is essentially what it is, right? Passive income. You get access to real deals, commercial real estate. You get professional management, you get tax benefits, diversification, potential for high returns, and equity growth, right? The cons of investing in syndications: it's illiquid. You can't take your money out. You can't just hit sell. You get a risk of loss, a total loss. You have limited control. You have fees and profit splits that, the syndication team will take. There's minimum investments higher than normal, not $25, not $100. You got to put up sometimes 25, 35, 50, 100, and as high as $250,000, right? Accreditation requirements and due diligence. So I hope that was a very informative video for you guys. Just taking a look at the poll. The question was, do you own real estate? Do you own real estate outside of REITs? 22% of you said, hell yeah, best asset class. 77% of you said, nah, I prefer stocks. So I'm with the hell yeah, best asset class, because I do own not only rental properties or rental property, I also invest into real estate syndications. So guys, with that being said, it was one hell of a long video, one hell of a long presentation. I hope you guys got a lot of value from this. Yeah, that's it. I hope you guys got a lot of value from this. I know this was this might be outside of most people's wheelhouse. But again, I just want to share the wealth, share the knowledge with you guys. So you guys at least have maybe a different, alternative other than the stock market. So with that being said, guys, I got to get going. It's the top of the hour. I hope you guys have a great rest of your evening, a great rest of your day. And I will see you guys in the next stream. You guys take care.